Okay, in this video, we're going to discuss a little bit more about investment decision making. We have another technique or two to talk about. But again, let's continue our emphasis of reevaluating, talking maybe a little bit more, too many times over and over again about the process, right? So sometimes we need to choose between projects. We refer to these as mutually exclusive projects. And the challenge, as we've talked about in previous videos, is that frequently the rules conflict with each other. So if you only have one to pick, how do you pick? Now, the net present value rule says you should select the project with the highest net present value. The internal rate of return rule says you should select the project with the highest internal rate of return, but that could lead to mistakes, right? That could lead to injuring the value of the company. But let's think about this a little bit more, right? If you were going to select a project based on internal rate of return, and obviously that must be an acceptable project. So the internal rate of return must be higher than the cost of capital, or you wouldn't accept the project. That also indicates that it has a positive net present value. So even though when they say we're making a mistake, we're not really injuring or reducing the value of the company. We're just not maximizing the value of the company. So choosing by internal rate of return, although it may not give us the optimal answer, it still will give us an answer that will increase the value of the company. But why are these conflicts here? And we've talked about these, but it's maybe not intuitive as to exactly what's going on. If a project size is doubled, its net present value will double. However, the internal rate of return will not also double, right? So the internal rate of return would stay the same if everything was doubled. So again, what about the timing of the cash flows, right? Even if the dollar values are similar, where the cash flows occur in the timeline are very important, right? Internal rate of return is a return, but the dollar value of earning a given return depends on how long that return is earned. So if the cash flows are switched, bigger cash flows are moved to the end of the project, that will have an influence on the internal rate of return of the project. In addition, if you think about internal rate of return, right, which would you rather make? Would you rather make 100% or a 50% on your investments? And of course, you'd want to make 100%. But what if there were two projects? You can earn 100% on a dollar investment or earn 50% on a $1,000 investment. The size of the dollar and when it occurs is very important in the decision-making process. What about the differences in risk? An internal rate of return that's attractive for a safe project might not be attractive for a riskier project. So again, internal rate of returns should be higher, could be higher for investment opportunities that are riskier. Yet the net present value, right, could be on the low side, right? So the higher the cost of capital means the higher the internal rate of return necessary to make the project attractive. And of course, the higher the cost of capital, as the cost of capital goes up, net present value goes down. So ultimately, there is this trade-off between the cash flows, when they occur, the risk of those cash flows, the magnitude of those cash flows. They all have influence on the internal rate of return and the investment selection process. So again, they generally give the same ideas. We've talked about this. Non-conventional cash flows. This is where they change more than once. That's going to have an issue with internal rate of return. And mutually exclusive projects. Again, it's going to have an issue, going to have a problem when we have these, when we have to choose or rank projects. It might do it differently. We have a technique that can help us a little bit with this internal rate of return issue, and that's called the modified internal rate of return. And there are several ways that you can calculate this modified internal rate of return. And quite frankly, they all give different answers. So it is a challenge of trying to figure out which one of these techniques is the best technique to use. But essentially, we want to calculate the net present value of all the cash flows, outflows, using the borrowing rate. And then we want to use the cash flows of all the inflows using the investing rate. So there's two rates of return here when they talk about modified and internal rate of return. The benefit to this modified internal rate of return is it provides us with a single answer and specific rates for borrowing in and reinvesting. So here's where I kind of approach this modified internal rate of return and what it can do for us. The modified internal rate of return essentially takes all of the future cash flows and assumes we're going to reinvest them at a different reinvestment rate than what we can today. Again, we obviously know that interest rates can change in the future. So the modified internal rate of return is a technique that can utilize. It assumes we reinvest all those cash flows to some future value. So now if you think about it, we have a future value of cash flows and we have an investment. So that means we have a present value and we have a future value. And let's say we know that that took 5 years. We can solve for the interest rate that would equate those two values. That's essentially the modified internal rate of return. And I believe there is a Excel formula for the modified internal rate of return. But in the end, what it gives us one answer, regardless of how the cash flows occur, whether they alternate signs, etc. But it gives us a better internal rate of return number, if you will. So now if you look here, if you remember Project B was the best of the two projects using net present value, but internal rate of return rearranged those. It ranked them differently. But in this case, the modified internal rate of return keeps these cash flows in these projects in the same order. So it might, not always, but it might take care of the conflicts that we had when you think about the internal rate of return and it's conflicting with net present value. Another technique that we can talk about is something called the Profitability Index. It is essentially the benefit or the present value of the cash flows divided by the initial investment. If this is greater than 1, you would want to accept the project. Less than 1, obviously you reject. So if you think about it, it really is kind of net present value. Net present value was the present value of the cash flows minus the investment. Now this is a quotient. Now if the benefit is greater than the cost, which is what net present value is all about, then you would want to do the project. So this profitability index, right? We can use this to help us to identify, I like to think of as being more, just being better stewards of our money. Identify optimal combinations of projects when we really want to look and think more about how much money we're spending on the projects, relatively speaking, right? So it provides us a picture of utilizing dollars in the most efficient way. So it gives us the best bang for the buck. And again, if it's less than 0 or less than 1, we wouldn't do the project. That would imply it's a negative net present value project. Now again, just like internal rate of return, the profitability index may rank projects slightly differently. So we do have to keep aware that there could be some differences in how things are ranked. The disadvantage, again, we have this ranking issue, but on the other hand, right, it might be useful if money is limited to make sure we use it the best way we can. It's certainly easy to understand. And for independent projects, just as it is with net present value and internal rate of return, it does give us the right decision with respect to independent projects. And as you see here, it has switched again back to Project B, saying that Project B has a higher profitability index. So Project B is the better of the two projects. So now we have what? Net present value says B, internal rate of return, or modified internal rate of return says it's B, and likewise so does the profitability index. So at least we're getting no conflict with respect to those four or those three discounting cash flow models, if you will, or capital budgeting models. One of the things we may want to do is to make some analysis between projects, right? Which of two projects are better? One way we can do this, or another way we can do this, is look at what's referred to as the incremental return rule. So here we have these two projects. We can do a major overhaul. So we're going to spend some money today, and then that's going to play out over the next 3 years. Or we can just do a minor overhaul, right? There's spend $50,000, and again that has higher cash flows over the next several years. So the first thing we know is what's the internal rate of return for each proposal, and again, is there another way we can do this calculation? And of course, in this case, we also have that the cost of capital is 12%. So we do have a worksheet that's available. It's called the Capital Budgeting Project Analysis. You identify the projects, right? So here's the net present value and the internal rate of return for the two projects. We see the project one is internal rate of return is higher than it is for the second one. Net present value, though, is lower. So how can we analyze this? The incremental cash flow is just cash flow 1 minus cash flow 2. So negative 10 minus a negative 50 is 40. And then 6 minus 25 is negative 19. So here we have our incremental cash flows. And the net present value of the incremental cash flows is negative. What that means is Project 1 is not as good as Project 2. It is providing, if we do 1, it is providing a negative relationship. That is, we wouldn't want to do it. The crossover rate, which is the rate at which the two projects would be equal, in this case is 20.0%, right? So again, this particular incremental return calculation gives us an answer as to which project is better. And here again, if we look at the net present value profiles of the two projects, and you can see for lower projects, the major overhaul is more beneficial because of higher net present value, higher discount rates, it swings to the minor overhaul, but dead center in the middle is where they were equal. That'd be at 20% roughly range. You can see here's the internal rate of returns. So again, depending on your cost of capital will make a difference on which one of these projects is the best project to do. Look forward to talking to you in the next video.